Hey everyone, it's Imran back again with another macro options spotlight. All right, US stocks reacting pretty positively to the weakening inflation data yesterday. Came in slightly lower than expected, showing that continuing disinflationary trend that the market's looking for. Tech stocks once again outperforming. Nasdaq managed to eke out over 1%. Europe and Asian markets did lag somewhat, and then precious metals choppy, did spike first, but then came back down, ended lower along with the other commodities, particularly the likes of copper and nat gas down on the day. Now, uranium, on the other hand, did eke out some more gains, 1.2% higher. That's continuing on from a strong week, now up 8.7% week on week. Looking at vol, we did see vol get whacked back down again. So over a vol point across the major US indices. European vols a bit more stable. And then looking across commodity vols, all down about half a vol, except for copper, which was small higher. Looking over at skew, we saw skew down about half a point. Obviously, it's been quite firm lately on the debt ceiling worries. It's still in the fairly high region at 55%, percentile range. I know that's median level, but that's quite high versus where we've been over the last sort of 6 months. So it still feels a bit elevated, that skew. I don't think we're going to see material softening of that skew until the debt ceiling standoff is resolved. And then in terms of commodity skews, we saw a small bid coming back for the metals, puts, whereas nat gas saw sellers of puts again taking it back down to zero on that skew, pretty much symmetrical. And we suspect there may be a nat gas revival coming at some point, given what the vol market is doing. That's the kind of sense that we're getting. Right? That's what my spidey sense is telling me. Looking over at some of the charts that caught my eye, we mentioned earlier in the week that the dollar seems to be getting a bit exhausted on the downside. And if there is a recession coming in the next quarter or two, we may see a safety bid come back as other economies get forced, or other central banks get forced to pivot on rates and follow what the Fed has done. So we looked at some potential upside plays in the dollar earlier in the week. And another interesting gap on that sort of theme, we can see here the euro often tracks the difference between the European and the US economic surprise indices. So that's the purple line, which has rolled over pretty dramatically recently. European economic data surprising relative to US economic data. Generally, you'd expect the euro to track that move to some extent, given how dramatic it's been. We have started to see a little reversal in the euro after ECB hike 25, tried to speak hawkishly, but we saw an intraday reversal from around 111, and we're back to around 109 now. So if we break below sort of 108.5, then we may be on to retest sort of 105, 106 area in euro. That's the type of move that we're anticipating is fairly possible. Okay, what else? And obviously FX vols are quite cheap in general, so we did flag some September euro puts as well last week. Now, another interesting gap is the being flagged by Goldman's research is between the hard data and the soft data in the NFIB surveys. Generally, the soft data leads the hard data on the way down. So soft data is this gray one versus the white. We've seen a pretty dramatic fall down to levels, similar to what we saw in 2008's recession. So you would expect this hard data to follow suit. It has started to tick down, but there could be a reasonable way to go if what happened in 08 is anything to go by. It's just something to be cautious about. Things aren't so rosy out there, and the leading data is certainly looking not so great. Okay. All right. Moving on. What else? So the message really is hedge when you can and not when you have to. Okay. So we've had, potential reasons to be concerned. The broad equity market has found itself near the top of the range again, with a decent amount of cuts being priced in already in the rates market for the Fed. So there's a fairly high hurdle for incremental dovishness. We've got the debt ceiling standoff, which has a precedent of triggering a bit of risk off in the market. And it probably goes to the 11th hour as there's political incentive to do that. And then, valuations in tech looking pretty lofty again, given how well those stocks have done recently. So we think this may be an opportune moment to put some fresh hedges on the book. Now, in the near term, we look at 4,200 on the S&P and 420 on the SPY as pretty strong resistance here. And then, you can back that up with the fact that you've got these cool walls from our friends at Spot Gamma at 4,200. You've got this not massive, but quite a large JP Morgan call strike at the end of this month, parked at around 41.93. So all of this is providing the street with upside gamma. It's going to make that resistance even harder to break. So not only have you got the technicals going for it, you've got the positioning of the market in gamma space, preventing the market from being able to break that. Now, if it did still manage to break that level, then we could well get a squeeze up to like 430, 440 in SPY, which is why I don't really want to sell the upside, because the vols are already reflecting the fact that everyone's long up there. So the absolute levels of vol are quite low. And if we did get a bit of a move up that triggered in a lot of these people who are underweight equities being forced to buy, then who knows how much we could squeeze. So I wouldn't really want to be selling calls right now. But I do like the idea of putting some medium-term put spreads in the book on the S&P. So looking at the S&P dashboard, we can see here that we've got vols obviously pretty low. Now spot, bit sort of neutral, middle of the range, not really on the top or the bottom of the Bollinger Bands. But like we said, skew's elevated. And the nice thing about looking at the medium term is the 90-day skew is even more elevated. So you've had the short-term skew pull back a bit, but the 90-day skew is pretty pumped still, okay? We look at the term structure, the front end of the curve's at 14, but if we go out to September, it's at 17 still. So there's a lot of, this is what we call roll down. If the curve is steep in contango, owning that vol at 17 and nothing happening for 2 months can be risky, because that 17 will roll down the curve towards 15 or something like that. So whilst Vega looks cheap in the 1 month space, which is what we track on our strategy compass, the 3 month vol still has roll down associated with it. So you don't necessarily want to be outright long options or long puts if you're hedging. So that's why we land on put spreads, because we basically get to keep the position a bit more Vega neutral in the medium term in September. So we're not exposed to this vol at this high level coming down. And we take advantage of the elevated skew by doing a put spread. So what put spread do we land on? Okay, that's it for today. Thanks for listening. I'll be traveling tomorrow, so there won't be a spotlight tomorrow. So I'll catch you guys back again on Monday. Cheers.